Hi everyone, Daniela Cambone here for ITM Trading with a reminder before we get to today's interview that if you haven't taken advantage of your free education session with one of us here at ITM Trading, I strongly urge you to book your appointment with one of our analysts here. You could do so. There is a Calendly link below in the description of the video. You pick the time, you pick the day that works best for you, and someone will help you build a foolproof wealth preservation strategy based on owning physical gold and silver. Do it, you won't regret it. Hi, Daniela Cambone here for the Daniela Cambone Show on ITM Trading. The market, my next guest says, is looking like it's in a perfect setup for investor panic and a coming stock crash. He is considered one of the most bearish on Wall Street right now. We're going to be hearing from Michael Gayed. He's a portfolio manager over at Title Financial, the author of the Lead Lag Report. I love his stuff, love his podcast. Love his angry X rants. Michael, so good to be back with you.
You know why I'm the most bearish? Because I'm the only one that's bearish by definition. That's why I'm the most bearish.
Well, you've been warning us, right? And that's what I want to talk about today, because on August 11th, can correct me if I'm wrong, you tweeted that come September, it's going to be a perfect setup and it could be a really, really bad time for stocks. So let's talk about what you see ahead here.
Yeah, well, okay, and that was a clip from a longer video.
Yes.
Post carry trade. Remember the whole carry trade thing where it looked like the world was going to come to an end, and then everyone became an expert. Everyone gave me high fives, and then everyone forgot about it because the S&P kept coming back.
I want to give you kudos because you've been tweeting Japan for how long now?
Since August of last year, when I was 100 pounds.
Right. This is the same Michael, by the way. This is the same Michael, and we're going to talk about his health journey later. You were warning about Japan, got hate for it, right?
Yeah, and so it played out from August 3rd to the 5th, right? I said, as everyone was high-fiving me around that momentary panic, that the market probably will rally very hard because suddenly everyone turned very bearish, and then argued that towards the end of the month, entering September, you could have another high-risk juncture. Now, when I say high-risk juncture, that's not me being a perma-bear or making some argument that stocks go down 80% and stay there. It's just an argument around not just seasonality, but where different signals that I track tend to sort of align and give a uniform message. Look, September anyway tends to be the weakest month of the year, right, historically. So seasonality-wise, you can make a case that we're probably due for weakness. I think everyone has lost their damn minds if they think that the reverse carry trade is over with Japan. You don't unwind a 2-decade dynamic in a matter of 2 trading days just because the S&P 500 recovered. And in general, going back to that point about being the most bearish because I'm the only one that's a bear, apparently, everyone's bullish, right? Everyone's just chasing the same narratives and story. When I see a setup like that, I get nervous.
You're looking at certain indicators, right? Rising price of gold, utility stocks, long-term treasury bonds. Break it down for me of why these are the warning signs for you.
So I think it's actually really important to recognize that it seems to me at least that the start of July was a very important cycle shift. When entering July, what happened? The yen bottomed, started turning higher. Value started outperforming growth. Small caps started outperforming large caps. Tech started underperforming many other sectors. So it seems like July was a very important mark in the sand for a lot of big momentum shifts taking place. I don't think people recognize that we're in a new cycle just yet. So they are still playing what has worked before, which is large cap, US, tech, and avoiding safety. And by safety, I'm really talking about long duration treasuries. One of my arguments around the reverse carry trade was that if it played out, it would spark the return of the flight to safety trade in long duration treasuries, meaning you would see yields falling as stocks fall. And that seems to be what's exactly happening. On big down days, guess what? Long duration treasury prices are rising, long duration yields are falling. That's a risk off type of dynamic. Gold has been sending a warning for a long time, just like utilities have been sending a warning for a long time. For all of the hemming and hawing around how this has been such an incredibly strong bull market for the year, utilities are the top performing sector, the most defensive part of the marketplace, right? The most bond-like sector of the stock market, utilities, have actually been the best place to be, the most boring part of the market. And typically, utilities are also a risk-off signal, meaning you tend to not see in a healthy bull market the most defensive sector being the number one performing sector. So you've got utilities short-term strong, you've got gold short-term strong, lumber has been awful, which I think is consistent with a lot of the data we're seeing around housing being weak, new supply coming in, and some pressure there on prices, which also should reverse the wealth effect and create some consumer stress. And I think in general, the marketplace is massively under appreciating how far delinquencies are going when it comes to consumer credit, auto loans. You are seeing stress in the economy. It's just not as apparent because everyone's just fixated on the S&P 500, when in reality, as I keep saying, most stocks, as we're speaking, are still below their respective 2021 highs.
So, okay, few good points there. So if NVIDIA is just holding up the entire system, what's your thesis? That will they go bust? Is that how it unfolds?
If NVIDIA goes bust, we are all in a lot of trouble. You may need to. NVIDIA may now be too big to fail, right? Because of how prominent it is in the S&P 500. It's like I joked about that before. It's like now you're at a point where if the Fed is going to step in to save the stock market, they are saving just a select number of stocks. I mean, that's actually how perverse this environment has gotten. No, but I do think well, and to be clear, there are other very large cap stocks outside of NVIDIA that have done fairly well, but just NVIDIA is the poster child for this AI narrative. I have argued repeatedly that NVIDIA can take down the entire stock market, not because of anything except math, given how prominent that stock is, right? So now it does look like the from a fundamental perspective, the growth is decelerating. Obviously, when it comes to NVIDIA, you're seeing some insane volatility as of late in NVIDIA. Now you've got some concerns over what the DOJ, right, sort of putting an inquiry there as far as NVIDIA goes, and antitrust and all this. So NVIDIA now has gone from darling to target. And if NVIDIA is a target, then I think that's going to, in general, bring on more volatility again in a month which historically, September, tends to be volatile no matter what.
When you're talking about signals, let's talk about the news this morning about the yield curve, bond market yield curve, returning to normal from an inverted state that it had raised recession fears in the past. Does this give you any sigh of relief?
Well, I think it's a sigh of relief from the standpoint that it'd be good to get a recession out of the way so that we can stop talking about it. Right, because typically it's on the uninversion when a recession then takes place. And actually, there was an interesting chart I saw from Swiss Re, where if you look at the way that the unemployment rate has been rising, typically at the pace it's been rising like it has been in this last several months, within 4 or 5 months, the recession actually hits. Right, so you combine that with the uninversion, which again is typically what you see just before a recession hits. It does seem like just as everybody was giving up on the recession, that certain indicators are now saying recession is even more likely, probably Q1, Q2 next year. Now, it's not a guarantee, right? But it would be nice to get it out of the way, because if you get a recession out of the way, then maybe some of these smaller cap companies can finally actually start to rally again. You have a recession, it's not only the antidote to inflation, it's the cure to rolling over your debt into lower rates, not higher rates. Because as we know, the Fed's going to respond by doing what it always does in a recession, which is liquefy.
I want to tie that back to what we saw happen the first week of August, right? Have a meltdown, then it goes away. Everything's back to normal. We can't take pain anymore, or the thought of pain. Yeah. So do you really think that recession's going to happen? Because it seems to me we can't, it's like we can't handle it anymore. We don't ever want to stomach it. It's not like the recession used to be back in the 80s and early 90s, Michael.
The good old days.
The good old
where
days,
recession
when your family would
time.
actually have serious talks. Like I remember my parents sitting me down, you know, when the recession was hitting Canada, saying like, look, things are going to get bad. And they did.
Yeah. There was tightening the belt as opposed to belts getting tighter because stimulus checks went to McDonald's.
Exactly.
Right. And it went overeating. It's actually an interesting, you're hitting on something which is, I think, actually a much bigger question, which is, can we even have a recession that isn't preceded by a crash that reverses the wealth effect and sparks the recession? Like we don't. It seems like if you think about the last few, in quotes, recessions, they have, to your point, they haven't been typical, and they've been more market driven, you know, from the reverse wealth effects on stocks going down, than because of the normal pattern of oversupply, over utilization, capacity utilization, and then, you know, slow down as a result, right? So who knows how whatever recession that's coming ends up looking, how long it would last, because to your point, nobody has any tolerance for letting a cycle play out anymore. It's just try to keep on papering over it. What I will say, though, is that if the response to every crisis is ultimately more leverage, then it makes the next crisis inherently bigger.
Right.
Right? Because now your starting point of leverage is even higher than the crisis before, which means the magnitude of a decline can be even more substantial for risk assets. So, yeah, you opened it up by saying, you know, saying crash. Again, I go back to, it's not necessarily me arguing for a crash. It's me saying that there's a risk of an extreme when you have so much debt in the system, and you're in a chaotic system. Small changes like what we saw with Japan raising rates by just 25 basis points can create a hurricane globally.
This risk of the extreme, I mean, on a scale of 1 to 10, how high do you see it happening in September? How likely?
I think it's actually pretty high, again, just based on seasonality. It's like if you're going to hit, it's probably going to hit around here. And the fact that everyone seemingly forgot about the reverse carry trade tells me that that's, you know, it's like this is what markets do. They surprise people, you know, when they're most convinced of any particular direction. So we went from the extreme of everybody suddenly becoming an expert around the reverse carry trade August 5th, to now the extreme of everybody saying, oh, the reverse carry trade's over, right? It was a nothing burger. And it's like, all right, I mean, the same people who were surprised by the reverse carry trade are surprised until they're not, right? Because of recency bias by the recovery, they're going to be surprised again, because that's what markets do, right? If I'm right that that was just a preview, and I really do believe that, it's not me being a perma bear or doing it for clicks or likes. Like, I do believe that was a preview of what could be coming with Japan. Then there's going to be some real volatility and pain. Again, not something that's permanent, but it can be a dislocation. And I do think that because it only happened roughly a month ago, you can have aftershocks. You don't need a year to pass by for another scare to take.
I think that makes a lot of sense. So for the folks watching at home, Michael, who are, you know, heavily invested in the stock market, they're probably thinking, well, what am I supposed to do if this is the case?
Well, the first thing one should do is make sure that they know their time frame, because if they don't need their money tomorrow and it's invested, then all of this is noise. It may actually just be an opportunity to deploy more cash into a dislocation because you're buying low. If you need the cash for something in the next week or two and you're in stocks, this conversation doesn't matter for you either, because you probably shouldn't be in stocks if you need cash in a week or two, right? I mean, I think you have to kind of do a little personal evaluation first and foremost. For those that are more active traders, right, that are viewing this as, all right, here's a scenario that could play out, and how do I position for that? I think the stuff that's working will continue to work, which means gold, which means utilities, and it probably means long duration treasuries, right, being the real play, because nobody seems to think that long duration treasuries can be a hedge anymore. I don't believe that dynamic ever changed. I just think the last 30 years were an aberration, and everyone assumed the anomaly was normal.
Just to touch on gold a second here, Michael. I mean, most of the rally really driven, you know, you can make different arguments, but look at central bank demand, right? But the retail investor, right, at least from what I'm hearing and seeing, has not shown up yet. Are you seeing the same thing?
Yeah.
Are you hearing the same thing?
Yeah, because 100%, because what the retail audience is now primarily skewed younger post-COVID. They tend to skew more with a DraftKings gambling mentality where they want to YOLO, and they tend to skew more towards digital cryptocurrencies. So you're exactly right. They haven't showed up because they're not old enough to.
Interesting. So it might take a while till they get to the point where they feel, yeah, maybe I should start adding some gold.
Yeah, I think so. I keep going back to this point that uptrends live on skepticism. They die on conviction. Okay, so it's not a surprise to me, for example, that Bitcoin has gone nowhere post Bitcoin ETF launch because everyone was convinced that it's going to go higher and higher because now you have these vehicles.
Yeah.
Yeah. Everyone is always wrong in this business and right. That's the way it works. But it's funny how people that are so incredibly wrong don't ever admit it or do some self-reflection. I have been incredibly wrong timing-wise on a number of things. I've also been incredibly right, but at least I'm public about it. Whereas a lot of these Bitcoin, and crypto people are so adamant about a certain dynamic playing out, and they're forgetting that it's that if everybody else is adamant, it's probably already priced in. It's not a contrarian opinion to think Bitcoin goes up. It is a contrarian opinion to think gold goes up, though, because nobody seems to believe that gold can continue to run.
That's right. But you believe it can.
Yeah, I every time I say gold is sending a warning, what I'm addressing is what I believe is a fact, which is that there's big money that's worried about the cycle. They're worried about correlation and beta. They are long only, and they just want something that can hedge against equities, or at least have lower the correlation of the portfolio overall.
Is it also sending a warning about the US dollar, though? Is it more telling about what's happening with the diminishing purchasing power of the dollar?
Probably. I mean, I if it were just about that, then I think you would see other things, which arguably have gone up, but I think the pace has slowed down quite a bit. Other things also in sympathy performing well, like Rolex watches, like artwork.
Yeah.
Right. I mean, it's basically precious metal and precious things from that standpoint. Yeah, I think there's some element of that. It seems like gold's movement largely has been based off of two macro factors. One is these periodic flares and concerns around Israel and Iran. Right, the sniff of war, right, causes gold to seemingly move in advance of strikes. And then the other dynamic I still think is Japan. So I think it's less about the dollar itself. I think it's more about, if you're going to argue from currency perspective, I think it's more about the yen.
As we're wrapping here, Michael, let's talk inflation cycle quick. Is it alive and kicking, heartbeat, or dead? Seemingly, with the Fed wanting to cut rates here.
Can I tell you next year? Can I come back and tell you? Which that's no, but it's funny. I do these podcasts, Lead Lag Live, and I had Miss Schneider on a little bit earlier today, and she made an interesting point. She said, if you look at commodities, and more than just gold, you look at the ag side, look at copper. A lot of these patterns look like they're maybe bottoming out, similar to what happened in the late 70s. So her argument is, which I actually can buy, that commodities are probably due to now have a recovery phase. Now, if commodities have a recovery phase, that's cost-push inflationary pressure. Cost-push inflationary pressure now complicates anything the Fed tries to do with rates, because they might be lowering rates to counter a recession, but at the same time, then you've got the inflationary pressure coming back suddenly from the commodity end of the world, which gets you back into the discussion around stagflation all over again, which everyone, I haven't heard that term stagflation for the last year. It might be due for a comeback.
Oh,
right.
It's the next.
So I think that's exactly right. I think the broader point remains the same, right? It's nobody knows what tomorrow is going to bring. Right? You can make an argument for inflation, you can make an argument for deflation, you can make an argument for stagflation. The range of outcomes is very wide, and when the range of outcomes is very wide, the implication is, from a portfolio perspective, you don't have too much conviction in any single thing. You have exposure to everything.
Michael, final thoughts here. I just want to bring up your incredible fitness journey. I mean, anyone who's followed you over the course of the year, it's like you're a different person. I mean, do you even recognize yourself? I mean, you lost over 100 pounds, and you go through these incredible fasting periods. You changed your entire life. But a lot of people will come up to me and say, you know, Michael has really inspired me. I mean, you tweet all about this. You're so open about your journey, and you are motivating and changing other people's lives. But the number one question I get is, I want to follow what Michael's doing, but they don't even know where to start. They don't even know how to start. So if you had to give advice of, okay, if you want to follow what Michael's doing, you're interested in fasting, and you saw all those reports how maybe fasting's bad for you. I didn't even ask you about that. How does one, is it overwhelming? It can be. So how does one even just start?
Yeah, listen, I mean, it's like anything else, right? I mean, I just spent a lot of time on YouTube watching videos of gym bros talking about one meal a day and intermittent fasting and extended fasting. There's a reason why I have a phoenix, you know, because it's about rebirth, right? I wear this as part of my shtick. Even at the gym, it's like right before I'm about to get and do cardio, I put it out. It's like a power up for me mentally. I know that sounds silly, but it kind of keeps me going. Anybody that thinks that fasting is bad for you needs to talk to Jesus Christ. Okay, because I'm pretty sure it's a concept older than the Bible. Okay, but yeah, it's not as hard as you think. Although I was with somebody this weekend, a couple friends, and the person said, you know, people confuse easy with simple. It's simple. It's simple. Don't eat. Just let time heal your digestive tract and trigger these biological processes. It's easy. Not exactly simple.
Well, like I said, you have touched a lot of people's lives, but next step, no seed oils for you. You gotta.
No, I know. I can't be perfect.
I said, can you tell them I'm mom? I'm just nagging you now. No, you've done an incredible. It's really been an incredible journey for you. So keep going, keep motivating others. I'm glad that you're using X for something positive. You know. So
yeah, it's supposed to be me screaming like a lunatic in all caps, talking about the VIX not going to zero, bro. Yes, I try to mix it up from the persona of old to the more real and authentic me. Well, because you got to be somewhat entertaining, you know, and hopefully right.
And hopefully right. So, like I said, we'll see how September pans out. A lot of people watching this are going to be hoping you're wrong. So we will bring Michael back. Michael, thank you always for joining us. We'll see you soon.
I always appreciate it, Daniela. Thank you.
And thank you all for watching. We'll have more great content coming your way. So be sure to stay tuned to the Daniela Cambone Show here on ITM Trading and sign up. DanielaCambone.com to stay on top of it all. That's it for me. Thanks for watching.